Good morning from London. I'm Anna Edwards alongside Tom Mackenzie. We're an hour away from the opening trade. Here's what you need to know. European and US futures are in the green as Asian stocks gain, heading for their best week in more than a year as strong US retail and jobs data ease recession worries. Ukraine says it's accepted the surrender of the largest group of Russian soldiers since the start of the war as Kyiv continues its cross-border incursion. We'll bring you all the details. Plus, Sweden records the first case of the new Mpox variant outside Africa, a day after the WHO declared a global health emergency.
It is risk on, Anna, across these markets. The setup then looking positive for the European trade this Friday after, by the way, 6 straight days of gains for the S&P. The S&P has added close to 7% over that time frame. European futures then pointed to gains of 0.5%. The data story out of the US pointing to that potential Goldilocks scenario. FTSE 100 futures a little softer, gains of 0.1%. Commodities are squeezed this morning. The 2-year still being sold off 2 basis points higher in terms of yields at 4%. Back above 4%. Euro dollar at 109. A little bit of strength coming through for the single market, single currency, up 0.1%. Markets refocusing and readjusting their views around this Federal Reserve. Fewer cuts being priced in. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. This is then the opening trade. It's just gone 7 o'clock here in London. Let's get, Tom, straight to some of the breaking news we have out of the UK. And we've got another set of data, another day this week and another set of data out of the UK. Today, it's retail sales. And so we're up by 0.5% on retail sales. This is the month-on-month figure. And that's almost the number we were expecting. We were expecting that to gain by 0.6%. I will say that the prior month, the drop the prior month has been revised upwards. So that net perhaps balances itself out. Now, as a result, we really don't see much movement in the pound, and perhaps the pound as exhausted looking at UK data as the rest of us this week, because we've had CPI, of course, that came in a little below estimates, but the jobs market looking tight. The growth story, as expected, pretty resilient. A lot of data out in the UK. Yeah,
and you tie it to the jobs data, which, of course, is really crucial when you think about the consumer and you think about these retail numbers. We saw wages then cooling, but still above that 5% level here in the UK. So wage growth slowing, but the unemployment number reducing, or at least the number of workers in work in the UK increasing. So, as you say, the jobs market broadly looking relatively resilient, but people's wages are coming down a little, still above 5%. And again, the retail sales print essentially in line, doesn't really change the calculus you'd have thought for the Bank of England. We were speaking to Credit Suisse chief economist just in the last 10 minutes. She says November is the right time. Markets are right to be pricing in the next cut from this Bank of England, not September, but November. OK, and it is interesting, given the things that were supposed to drive this number higher this month, you know, they were obviously there, but whether they're as strong as we would have expected, so maybe that leaves the Bank of England cuts in place. So, for example, the warmer weather, yes, believe it or not, we did have some, Tom. Our memories, perhaps, it doesn't stand out in my mind as much as all the rain, but the football as well as supposedly boosted spending. So the fact that we had those positives and we didn't quite get to the estimate, I don't know, maybe at least leaves those Bank of England cuts on the table. Interesting, after that growth number yesterday, Bloomberg Intelligence talking about the risk of overheating in the UK economy in the second half of the year, which if we have a Bank of England that's cutting interest rates is a really interesting conversation that we'll no doubt pick up. And it's a stunning reversal, isn't it, from the recession environment that we're in. Briefly, but you've had 0.7%, 0.6%. So expectations that the growth in the UK will continue to grind higher. It presents, of course, a brighter picture for the new Labour government, but still they are constrained in terms of the fiscal spend. The data out of the US as well, arguably there's the political read across there because it came in more positive in terms of the jobless claims. We know there is that scrutiny now on the labour market of the US, with Fed officials coming through and saying we are now more focused on the labour market than we are on inflation. Jobless claims coming in slightly lower. Retail sales, a jump of 1%.
Yes, so better news on the US economy. And what was interesting was that we saw yields go higher, 2-year yield up by 16 basis points or so in session. We also saw stocks go higher. So it doesn't seem as if that movement in yields to the upside is something that's going to put stocks off. Good news is good news, it seems, for various asset classes right now. Traders were paring back their bets on a super cut in September. I mean, maybe that didn't look realistic going into this data anyway, because yesterday we were talking about how that seemed to be off the table.
That was a week and a half ago. A week and a half ago, Anna. It wasn't that long ago.
The market's moving quickly. The sentiment's moving quickly. And there's another, what is it, a week until Jackson Hole? Or is it, I can't remember which day it is next week, but certainly our coverage of Jackson Hole will be mindful of all of the volatility that we've seen and all of the really shifting expectations around the Fed over the last 2 weeks.
Because there'd even been some notes about it a week and a half ago suggesting that maybe at Jackson Hole, Jay Powell would announce that emergency rate cut. That clearly seems very unlikely at this point. And a 50 basis point cut in September for many would smack of panic when the data doesn't seem to justify
Yes, and it will be interesting to see what line he takes, whether he does signal that cuts are coming and signals more likelihood of September. What language does he choose to do that? But also, does he weigh in on that balance of risks between jobs and inflation? The Fed has the dual mandate, and so far we've heard, as you say, from lots of other Fed officials, but not him on that front.
Austin Goolsbee and Raphael Bostic, quite clear in terms of the way he communicated to the Financial Times yesterday. September is open, and to your point, Austin Goolsbee saying for him now, the balance of risks, the focus has to be on the labour market. OK,
let's move on to another item on our agenda this morning, and that is certainly the carry trade. And I heard you talking about this at the last part of the last hour, Tom. But, you know, the comeback of the carry trade seems to be all the rage, and certainly what we're talking about, at least at the margin. So with the unwind of the carry trade had a big impact. Are we seeing something a little different? Is it turning around? The strong US data was the driver for this, as you might expect, given what we'd seen on the week data a week and a half ago. But it seems Nomura are now saying that hedge funds and corporate clients are busy putting on those trades, you know, going short yen and buying up the pound or the Aussie dollar, or maybe even US stocks. And I know we've got a chart that demonstrates how the yen and US stocks are now moving back in sync with each other.
Particularly the yen and the NASDAQ. And hats off to our production and terminal whiz, Dan Curtis, on this front, because he's pointed out the fact that there is that correlation. When the NASDAQ sold off, yen strength, and that correlation was there. The correlation is back this time. Yen softness coming through, down 5% in the last since August the 5th, and that money has moved in to tech stocks, at least some of it. So the carry trade, at least around the margins, as you say, Nomura saying it is back.
And we'll have to wait and see what the CFTC data says, if that backs that up, because that's a sort of slightly more definitive take on what hedge funds are doing, but it's a bit delayed. So the most recent data doesn't show this trend, it shows the unwind of the carry trade. We'll see what the latest data shows, and that's later today. That's
later today. And how much do you want to lean into the carry trade, given that we do have Jackson Hole, we do have Jay Powell speaking next week, and of course, the way that he frames and communicates around the Fed, really consequential for how you think about the carry trade and the BOJ's next steps. And Ueda as well, the governor of the BOJ, giving that evidence and testimony to the Japanese Parliament next week. Let's tell you what else is coming up on the show this Friday. Ross Hutchinson, head of Eurozone market strategy and economics at Zurich Insurance Company, joins to discuss the return of the currency carry trade, the yen carry trade. Meanwhile, Sveland's Capital Director Nadia Martin-Wigan joins to talk about natural gas hedging and oil as well. Really, of course, insightful and important take coming through, we hope, of course, on the energy markets, given what's happening, particularly in the Middle East and soft demand out of China. At the Open, Bank Lombardier Odier's EMEA CIO will join us. So some takes in terms of how the markets are adjusting. We're going to dig deeper as well into those UK retail sales number that just crossed, largely in line with the estimates. And that's going to be with Karen Johnson of Barclays. So we'll take there on how the UK consumer is adjusting and to what extent the sentiment is still there and still positive in the backdrop of a slightly stronger growth picture here in the UK.
Yeah, lots to talk about on the UK front then from a host of data points released to the markets this week. Here's what we're watching out for then today. We still have some data to come, a lot of it from the United States. US building permits and housing starts. We'll get that data at 1:30 UK time. Then an hour and a half later, we'll get the University of Michigan, so UMich consumer sentiment. Just before 6:30 UK time in the evening, Fed's Goolsbee will be speaking at an event in the US. And finally, Moody's has a rating update on Ireland to bring us. I mean, these aren't the data points that typically, well, I was going to say typically don't move markets. I suppose consumer sentiment stands out then, Tom, as one that will be in focus. And we heard from Walmart, and there's evidence of a bit of consumer weakness in their strength, in that customers are trading down a little bit.
Yeah, really interesting that higher net worth, wealthier clients, wealthier customers are maybe moving to Walmart to do their purchases. So they're kind of benefiting from that step down in terms of US consumers because, of course, they're known for keeping prices lower. But it was the outlook that led to the stock rally for Walmart, and the number overall coming in, I think, for the quarter above 4% in terms of sales for that business. So a really important touch point, of course, in terms of the US consumer coming through and the more positive outlook from Walmart. Here's what else you need to know this morning then. Sweden has reported a case of the new Mpox variant, the first recorded outside of Africa. Sweden's public health agency says the person was infected during a stay in a part of Africa where the new strain is spreading. The agency says the patient's treatment doesn't pose a risk to the population at large. Gaza ceasefire talks are underway in Doha between Israel, Qatar, Egypt and the US in an effort to cool tensions in the region. Although Hamas representatives are not due to be present at those talks, officials say mediators will brief the Iran-backed group shortly after the gathering. And Ukrainian forces say they've accepted the surrender of the largest single group of Russian soldiers since the start of the war over 2 years ago. A source says 102 Russian servicemen were taken as prisoners of war in the Kursk region on Wednesday. And the developments in Russia with that military footprint of Ukraine right now on Russian soil and apparently extending is remarkable. And we have yet to have a definitive response from the authorities on Moscow. And I have to wonder how Western officials and allies of Ukraine are thinking about what is perceived to be, by most military analysts, a huge gamble from Ukraine.
Yes, and the question of what hardware and munitions are able to be used on Russian territory is also one that Western governments are dealing with. Interesting how this is having a bit of an impact on gas markets, not to over-exaggerate it, but we are seeing that the cost of insuring October natural gas contracts in Europe has moved higher than the cost of insuring the winter ones, and that's pretty unusual and suggests that there is some nervousness, even though Ukraine and Russia have both said that they will keep that limited supply that we see coming through, so they will keep that coming through. But there is a bit of nervousness there, although our colleagues pointing out gas storage for Europe is still pretty full, so it's not as if there's
You're above 90% on inventories in Europe, so it seems we're well positioned for the winter, and this is a single-digit percentage of gas flows from Russia to Europe. But nonetheless, as you say, it has seen that spike up in European gas futures and gas prices.
Yes, because Europe is a whole lot less reliant on Russian gas than it was, but there is still this limited flow coming through, and in particular Austria and Slovakia, I think, are still pretty reliant on this flow coming through, so we'll continue to watch that, and we'll get analysis of how the events play out on the battlefield and the market's perception of those risks around gas. Let's talk about other climate-related matters. In fact, coming up, the European heat wave has many countries on alert. We will look at the climate challenge a little bit later on in the programme. Plus, we'll bring you the latest on Mpox after the first recorded case outside of Africa surfaces in Sweden. Up next, recession fears ease, but are there more volatility drivers lingering? We'll discuss that next. If you want to get involved in the conversation, please do. You can use ID plus BBTV Go to get in touch with the producers who put together this programme. This is Bloomberg.
From my perspective, the risks to both sides of the mandate seem more balanced. Accordingly, the time may be nearing when an adjustment to moderately restrictive policy may be appropriate.
That was Alberto Musalem, president of the Federal Reserve Bank of St. Louis, speaking yesterday about future Fed policy. Let's start a conversation about the global economy on the US and then work into the Eurozone economy as well. Ross Hutchison joins us, head of Eurozone market strategy and economics at Zurich Insurance. Very nice, Ross, to have you with us. Let's start on the US, because it seems to be that the US data is broadly in the driving seat right now. Certainly retail sales and the jobs, the claims numbers of yesterday gave the market some reassurance about the trajectory for the US economy. How reassured were you?
Yeah, well, first, thanks very much for having me. I guess, first, there's been a lot of volatility in the US data in the short term here. Clearly, exactly as you said. I think overall, the numbers we've seen have been quite reassuring that, there may be a little bit of a blip in terms of of how the market was taking away the figures of the non-farm payrolls. Obviously, retail sales came out very strong, jobless claims good. But I think still it's important to remember that we are seeing, and it is our view as well, that the US economy is slowing down, is normalising somewhat, and part of that is a labour market as well. But this is kind of what the central bank wants to see. So I think there is some good news in this normalisation as well.
Yes, interesting, isn't it, that we got better than expected news around consumption to some degree, around the retail sales, Ross, and good news was seen as good news by markets, even though we are looking for cracks to get those rate cuts in. So, was this just this was soft landing, was it? This was Goldilocks?
I mean, I think, there are still some concerns about the US overall. I'd be hesitant to say that we are, fully confident that this is the soft landing Goldilocks scenario. I think, when we're looking at it from perspective, we still have a relatively high probability there could be a recession in the US, even though it's not our base case. We have seen, a variety of other indicators. I mean, particularly in, let's just say, the strength of the labour market overall, that much weaker. Yes, it's some normalisation, but we know these things tend to be a little non-linear when they do happen. Obviously, there's been discussion of the SAM rule that everyone has been discussing, and I think sensibly been discussing, because the Fed and everyone, investors certainly have to be very cognizant that risk does exist there.
So, Ross, what is the overlay then to the European economy? On one side, China as a catalyst doesn't seem to be there. The US, though, holding up, and you countact or put the context around a potential risk of a recession, even though you say it's not your base case. What is the outlook for the Eurozone economy, particularly with Germany front and centre, given some of the challenges around global trade?
Yeah, I mean, absolutely. So, I mean, I think on the positive note, if you think of where we were last year, so Europe, the kind of consensus for Europe was really gloomy. We were looking at forecasts of, the kind of very, very low, let's say 0.3% growth this year. Half one has been good for Europe. It's been disappointing for Germany. Yes, that's true. It's been disappointing for the manufacturing sector overall. But really, we've been looking at pretty strong growth in places like Spain, Italy. I mean, even France, despite some political turbulence there, still seeing some pretty good news overall. The concern is actually kind of on a more forward-looking basis into H2, as we're in now. The data in general is actually turning over a bit. So we've seen the PMIs come over, we've seen some business confidence numbers turn over in general. We don't think there's going to be a recession in Europe overall, but we do think there's just going to be a little bit more tepid news as we come into the second half of the year. And still, Germany is a laggard there.
So how does that inform your view in terms of the strategy then, the exposure you want to have to equities versus fixed income? Would your preference then be in that environment for a tilt to fixed income in Europe versus equities? How are you thinking about that balance?
So actually, I mean, really, when we look at fixed income in Europe, we think there is really this kind of siren call, luring investors into wanting to invest in fixed income. But I think the issue is when you actually look at the pricing in the market, you see tight credit spreads, you see tight sovereign spreads. And when you look at, for example, German bonds yielding, let's say, in 220, a little bit higher than that in 10-year, it's not entirely clear when you compare that to, current deposit rate of 3.75%. There's a negative carry involved there. It's not entirely clear, what more needs to happen to get you to get some real capital appreciation from the fixed income side. So we actually think that fixed income, although at the beginning of the year it looked, pretty expensive in Europe, relatively now it looks quite well priced, but we don't really think they're going to get an enormous excess return from that.
Ross, I just want to play a clip of one of our guests yesterday. We spoke to Hugh Gimber yesterday at JP Morgan, and we were trying to think about risks for the global economy based on the Bank of Japan increasing interest rates. And he was actually using this he was arguing that perhaps we haven't seen the full effect of tightening because cheap money still has been available up to this point over in Japan. Let's just have a listen to what he had to say.
Lots of talk over the past couple of years, really, about the end of cheap money and how well markets have digested higher interest rates. I'm not convinced that's the right read, because there is still cheap money available. It's available in Japan today.
Yeah.
And exactly, if the Bank of Japan is on a sustained hiking cycle through 2025, which is, in my mind, consistent with that soft landing for the US economy, then we're going to really start to learn about what the removal of negative and zero interest rates is all about.
So Ross, that was Hugh Gimber, and I suppose taking it to Europe, you know, we've had examples in the last week and a half of the risks for the global economy, the risks for the European economy then, of tightening in Japan. Is that still on your radar?
Yes, certainly. I think there is an expectation there could be some spillover effects there. But in terms of the relevance for the entire, so we say, monetary order and the cheap money element, I mean, Japan in developed markets is an outlier at this point in time. I think it's important to say as well is that, you know, the Japanese authorities are concerned about the level of the yen. The Japanese public, in many senses, is concerned about the level of the yen. And there is I think, a kind of a growing move towards, I mean, not just purely from a monetary policy perspective, but attempts to try and strengthen that currency. And all else equal, that means that we think, you know, there will be more iterative attempts. So while the rest of the world is starting to cut policy in various guises and sizes, they think that the Bank of Japan overall will still be removing the punch bowl to some extent. And I guess the other point of that overall is we are still in a global environment of quantitative tightening. And that's just from the ECB, that's from the Fed, that's from the Bank of England, you know, overall. And we're not expecting that to change. And the central banks are telling us that's not going to change. That's expected to run down in the background going on. And that could still weigh on the overall funding environment and, you know, the overall liquidity environment that we have overall.
What about the liquidity environment in Europe then, given that kind of global backdrop that you outline? And how you link that to your views around equities. Where within the equity space of Europe do you want to be sitting right now?
Yeah, so I guess from an equity market perspective overall is even though we are seeing, as I've mentioned before, this concern about a slowdown into the second half of the year, we still think that European equities and really kind of global equities can perform quite well. In this environment, particularly as we get into an environment where, you know, rates are being cut overall, the environment is improving somewhat. So when we look in Europe specifically, I guess one thing that stands out to us, firstly on a kind of country basis, is there has been an enormous underperformance of French equities relative to the rest of the European complex. We think some of that is overdone. We think there is opportunity there for, you know, a kind of reversion back to that. You look at the CAC, for example, has done very little to nothing on the year, where other indices in Europe are up about 10%. And we actually think there that when you look at the constituents of that particular index, fairly diversified, broadly diversified index, that there is scope for that to outperform some of the other European markets as well. And that's also linked as well to, honestly, what's been a relative resilience of the French economy, particularly when compared to Germany.
And Ross, next week we get PMIs from a host of European countries, and I'm looking at we haven't got survey data yet, but we do have, you know, the prior numbers, and, you know, manufacturing has been really sluggish in Europe for a very long time, below 45 on the readings of PMI for France and for Germany. Does that matter to markets? I mean, it'll matter in some sense, but will it be in the driving seat, or will we be all about the US data?
I think what would matter more for markets now is how much more is the service side of the European economy going to slow down. That has been the enormous driver. I mean, particularly in Spain, when you look at it, but overall in Europe, that has really been in the driving seat. And as you said, manufacturing has been disappointed. There was an expectation this year that there was going to be an improvement in the manufacturing story, particularly as energy prices had come down. We have seen that come into the numbers. Yes, they're creeping up a little bit more again, but overall, the story has improved relative to past years. And the really negative surprise there has been that even though we've seen small incremental increases in high intensity production, you know, high energy intensity production, overall the manufacturing figures, industrial production, even kind of new orders and leading indicators have all been disappointing across the board. Yes, Germany's a big part of that, but really, as you say, it is also more broadly. But I think markets have that European manufacturing story kind of priced. There is an expectation that's already there. That's a known quantity. If it deteriorated further, that would seriously be negative. But I think really the thing to watch there is services.
Ross, thanks so much. Thanks for your time. Ross Hutchison, head of Eurozone Market Strategy and Economics at Zurich Insurance. Thank you for your time. Coming up, could we see another winter of discontent as Europe's gas traders worry over rising costs and supply chain issues? We'll talk about gas markets. This is Bloomberg.
Welcome back. 30 minutes from the start of the opening trade. Here's what you need to know. Ukrainian forces say they have accepted the surrender of the largest single group of Russian soldiers since the start of the war over 2 years ago. Let's get more details then with Bloomberg's EMEA news director, Ros Mattison, who, of course, has been following all of this alongside the Bloomberg team. Are there signs then that Ukraine is planning beyond what is already an historic and significant incursion into Russian territory?
Well, that's the big question. I mean, beyond the question of intent, why is Ukraine, doing this now? What are their tactics? What's their strategy? Is how long is this going to go on for? Are they trying to take territory and then keep it to form a buffer on their border, which prevents, Russia massing troops in the border area and sending them over? And if so, they're going to sort of essentially sit in that territory for a long time. And what we know is they've said overnight they plan to set up a command post in Sudza, a command post that would then, essentially oversee that area, manage the flow of people as well. They're talking about making sure that Russian civilians can get out of the way. So that sounds like something a bit more long-term than perhaps we thought. Obviously Russia is trying to push them back out, but it does seem as though perhaps they're just trying to have that buffer zone just over their border for an extended period, that line of territory, maybe not pushing too far into Russian territory, but certainly having that sliver of land for the longer term.
So if Ukraine's intentions here, Ros, are a little unclear right now, how is Russia responding? You mentioned they're trying to push the troops back. This does seem to have caught them off guard.
Well, it has. We know, of course, from our own reporting that Ukraine was thinking about doing something like this for some time, and they've chosen now to do it. It's probably to try and force Russia to draw its better troops out of Ukraine. We know its better trained soldiers are fighting in Ukraine, and for Ukraine, it's better to have them back in Russia fighting in their own country, because the troops that have been operating against Ukraine on the border area are the less well-trained troops, kind of slightly rabble-rousy troops, less experienced, and therefore Ukraine's been able to make that ground pretty quickly. And so we're now hearing that Russia is starting to pull some troops out of Ukraine. They're very reluctant to do that, but it seems they feel they have to, because they've got to try and get this under control, because it's so, it's embarrassing for Vladimir Putin. He needs to show that he's regaining authority in this area pretty quickly. So we know they're doing that. We know they're continuing to fight inside Ukraine. So Russia is still striking inside Ukraine, probably trying to stretch the Ukrainian line in response. A defensive line in Ukraine has turned into an offensive line inside Russia, so they're going to try and stretch Ukraine in turn. But certainly we're seeing evidence they're having to pull troops back out.
Ross, do we have a sense as to whether or not this play, if it is around trying to have some leverage in negotiations, seizing territory and saying, look, you've got a chunk of our territory, now we have a slice of yours, do we have any evidence that that could prove effective for Ukraine, particularly as we watch events shape and reshape pretty rapidly and pretty distinctly across that space?
Well, there has been that increasing narrative and cadence around at some point, do we have to, get towards negotiations with this war? Even Ukraine has acknowledged that as we head towards, the third year of it. And, given the external climate of the US election coming and, will the global support for Ukraine continue at the level that we've seen? And so Ukraine has to really be in the best position possible if it has to negotiate. And that may have been a calculation, is if we grab a chunk of Russian territory, that may compel Vladimir Putin to agree to negotiate, and we're on slightly better footing when it comes to that. So it's possibly a tactic to compel Vladimir Putin to the table.
Ros, thanks very much. Bloomberg's EMEA News Director Rosalind Matheson with the latest on Ukraine. Now, clearly, commodity markets are paying close attention to developments in the Middle East and to what's happening in Ukraine and now in Russia. European natural gas contracts for October have become more costly to insure than those for midwinter, signalling that traders are bracing for possible supply disruptions at the start of the heating season. Joining us now is Nadia Martin-Wigan, who's Director of Svalent Capital, which is a commodities investment management company. Nadia, really nice to speak to you. Thanks for joining us. We were just hearing about the activity by Ukraine on Russian territory. Our colleague Ros Matheson was mentioning Sudza, which we know is, of course, a gas transit point, not for a huge amount of gas for Europe, perhaps, but still something that some countries in Europe still rely on. Nadia, do you expect to see disruption? The market is a little nervous about disruption on that pipeline.
Yeah, the market, thank you for having me. The market is nervous about a disruption happening there. The equivalent to replace the small flows that are going through there would take about every third day, it would be one LNG cargo. So if it were out for a month, then that would mean 10 cargoes. And if we were looking through the end of the year, that's how that multiplies. It's not expected to continue having transits from Russia through Ukraine anyway on the pipeline side of things. So the market is a little bit prepared, but right now, traders are preparing in case they need to cover those shorts with additional LNG imports. So they're not as bearish as they have.
Yes, that's important context, isn't it? That flow was expected to go anyway, but as you suggest, it could go earlier. I mean, we have had assurances from both sides that this isn't their intention, that they don't want to switch off this flow, and we do know that storage in Europe is looking pretty strong. So is there any concern ahead of the winter?
Absolutely, because when we look at the supply side, we are in a vulnerable situation in Europe. We have maintenance coming in the North Sea. Gasco is going into maintenance for 10 days in September. Sometimes maintenance lasts longer. We have had diversions this summer of cargoes that were initially supposed to come to Europe that went elsewhere. There was a big tender in Egypt, and we've had a reasonably high demand owing to the weather in Asia. So now we're going into shoulder season, so the market expects it to be well supplied, and it's starting to have a little bit of that bearish tinge again. But we are still very, very vulnerable on supply because our storage does not cover the full demand we require to get through the winter.
That's surprising to me, just how vulnerable we are on your analysis to the lack of gas, given the end-of-entry build-up and the relative success that countries like Germany have had in building out those inventories. Is it your assessment that corporations in Europe, that the markets in Europe are still a little complacent around these risks?
Yes. What we saw, we've seen pipelines and infrastructure attacked, even in the Nordic area, right, as we saw last year. So I think there is a vulnerability that things could happen there. The big savior, of course, has been the renewable side, because that has helped alleviate some of that gas demand. I think on the industrialization, though, in Germany, for example, we see that up 14% year on year. So that part is real demand going forward that is coming back. But we've been very lucky with these warmer winters, and now, of course, this more macroeconomic feeling across the markets that the world is not growing at the pace that some had expected. Of course, that sentiment is especially led by China and the U.S., but of course, Europe is still a part of that picture. Yeah. So it matters quite a lot on our demand side as well.
Nadia, thinking about the demand side and China and the role it plays, we saw slower industrial activity reported in data this week. We have more data on energy flows coming from China at the beginning of next week, I think. It is a big player in the import story. So what assumptions do you make about China?
Yeah, well, versus a lot of the headlines, we don't think things are as bad, but we cannot deny the fact that, food imports were lower, June, July than we had expected. In terms of official refinery runs, they were lower coming out of maintenance season. Also, following the flows with physical players, they were not running as hard as the market had expected. On the other hand, we do expect that to continue ramping up now, especially when we have maintenance season amongst refiners in Europe starting in September. So we expect more of that activity to go forward, and we've seen strengthening in the VLCC market and so forth. So we think those flows will continue to come. And unlike, I think, quite a few forecasters, we do not see these tremendous inventory builds coming in the second half of this year. We actually don't see overall builds coming in inventories on the oil side, even if OPEC brings back production as planned.
Nadia, you talked about the role of renewables in Europe and the build-out that continues there. As you project out in the years ahead, how are you thinking about calculating the flip around the demand for gas, or at least the consumption of gas, versus the role that renewables play? To what extent is renewables going to be replacing that gas component in the years ahead? How much progress is Europe making on that front?
Well, Europe is definitely making progress. However, I think it's very important to understand that still gas is a base fuel. that we need across the system that can be called upon very, very quickly. Until we have batteries that are able to store for much longer periods of time, we absolutely require that gas for a switching effect. And this is where the Ukraine war really showed this, because it wasn't that gas prices skyrocketed, and because of that invasion, Germany consumed much more natural gas in 2022 than it had in the past. And that helped save that balance when we had even outages, underperformance in some renewables, but comparatively, it was still growing. We had underperformance in the nuclear sector. In France, things like rain and hydropower. We're currently seeing this in Brazil, where that is a problem. So they need to pull in more LNG cargoes. They've been taking about a quarter of what they regularly have had in the past, but now because it's drier, they need to have that. So it's still a very, very important part of that system.
Yeah, Nadia, when we think about oil prices, going to another area of the commodities universe, we see the demand story sort of reasserting itself this week with the US data helping to support oil prices, perhaps, but also the geopolitics around supply supports prices, I imagine. What do you think is the geopolitical premium in oil prices right now versus where it could get to if we do see Iran take more action?
Well, I think that what we saw in this bounce back up from $75 a barrel Brent, it's been a very strong floor. Some of that is a risk premium. Is it $2? Is it $5? I mean, it can swing about. I think the market had started to expect ceasefires, and now the market has realized, okay, that was premature in terms of thinking. But if something were to truly escalate, what does that mean? Is it affecting actual production? Iran is a very important producer of crude, right? It's 3.6 million barrels per day. Are they out of the market? Are the Straits of Hormuz shut? Then that would be an extremely high number. But in terms of how quickly the oil price would jump higher. But that's not the base case scenario. At the same time, we find it fascinating how, when you look at the algorithmic trading, that we've been in this kind of bearish trend. We've seen sellers coming into the market since early July, even when demand was looking very, very strong, especially in the US. And so we've had parts of that selling into the market, and that would, of course, reverse. So that would create a lot additional premium as well.
Nadia, this might be impossible to answer, but what kind of premium would be applied if we did see the Straits of Hormuz shut?
It's impossible to say. It's almost like when we were with COVID and we had this enormous oversupply. How low could it go? It would be a very significant jump, and it would depend how quickly the straits could be reopened and how confident ship owners would be to send cargoes out. Because this is what we've seen with Suez. Even if we would have a ceasefire agreed, our view at Svelling Capital is that it would take at least 3 to 6 months of a non-event happening for ship owners to truly trust that they can use that passageway. So this is where the Straits of Hormuz, it's very difficult to say how quickly. I mean, technically, I'd like to see the U.S. Navy would reopen that up within 2 days, but how would normal flows, how long would that take? That would take more time to build that confidence.
Thank you so much, Nadia. Good to speak to you, Nadia Martin-Wigan, Director of Svelling Capital, answering tough questions on commodity markets this morning. Coming up on the programme, Bayer is one of our stocks to watch this morning after a US court ruling on its Roundup weed killer. Yes, another one. We'll get the details just ahead. This is Bloomberg. Welcome back to the programme. 7:47 here in London. It is Friday morning. European stock futures point a little bit higher, actually, including FTSE futures, which had been lagging behind a little earlier. US futures, Nasdaq futures firmly in the green again, up 0.5%. Let's talk about what's driving these markets. Our Markets Live executive editor, Mark Cudmore, is with us. And Mark, good news was good news for stocks yesterday, and also bond yields went higher at the same time. What did you make of the way that the retail sales data and the wider data picture out of the US is being absorbed by markets right now?
Well, I think we're normalizing. We're going in a better direction. I still think we're pricing way too many cuts from the Fed this year. As you know, and I haven't understood the sudden panic about the U.S. economy. We went from the start of July having no worry at all about U.S. growth to suddenly being convinced of a hard landing just because of a few slightly soft prints. The fact is the U.S. is still adding jobs. And yes, there's been a move up in the unemployment rate, but we have very high immigration still, so that needs to be discounted slightly. And most of their indicators show this is an economy still growing strongly. Atlanta GDP now, Fed reading, is still well over 2%. So I never understood the panic. I still think that the economy is doing absolutely fine. The bit that is confusing me is the power and straight line of the rebound. Even as someone who's stayed very bullish during the turmoil of the last month or two on a longer-term basis, I expected August to be volatile. I thought we'd have more whipping around. I thought we might retest the lows before going higher into year-end. But there's been no sign of volatility.
Yeah, the S&P, well, if you look at NVIDIA, I mean, there's some volatility there. It's been acting more like a crypto, hasn't it, in terms of the moves around the market cap of NVIDIA in the last few weeks. The S&P notching gains 6 straight days, to your point, around the straight line of upside, certainly in the equity markets. Mark, how are you assessing then? You talk about the relative resilience in the US economy, the pull and tug then of the strength in the US economy, the relative softness in China, iron ore taking a beating. You've got steel manufacturers in China screaming that there's a crisis, iron ore at $92 a tonne. What do you make of the impact on commodities?
I think it's another worrying indictment that Chinese economy is still struggling to escape, a slightly stagnating period. It sounds weird to say stagnation. We still got over 4% growth, but it's also a reflection of the fact that the style of Chinese growth has completely changed, and it's not going back. We're not going to the infrastructure boom of the past. So we do have overcapacity in this market. That the world economy is changing in terms of the infrastructure build. We're moving more towards a services-led economy almost everywhere, and for the largest economies in the world. And so that's why I think it's going to remain slightly tough for iron ore. But the companies behind iron ore are extremely efficient, still make good profits, so it's a less of a problem for the industry.
OK, and moving on then to where this all takes us, where this leads us to, Mark, what derails us now then? We do look pretty risk-on this morning for Europe and into the US session. The data's been reassuring. What can derail us?
Well, that's the thing. There are no real obvious catalysts in the horizon. We've got Jackson Hole in a week's time. Maybe it's that. Then we've got NVIDIA earnings. But, given we've rallied all the way to here without much volatility, you'd have to assume we carry on going higher. I am worried by that complacent view, given that I was expecting volatility in August. So I'm wondering whether there's some tail risk out there that might derail us. But at the moment, it's only second-tier data on the horizon. So there's no logical reasons to assume derailing next week otherwise.
OK, volatility gone from 60 on the VIX to, 15 now. Bloomberg Markets Live Executive Editor Mark Cudmore, thank you as ever. Remember, you can get up-to-date analysis and insight from Mark and the rest of that brilliant team. Just go to MLive Go on your terminal. Talking of brilliance, let's bring in Joe Easton from our Stocks to Watch team, our equity team, for your Stocks to Watch this Friday. Joe.
What an intro. I've got to live up to that now. So we are looking at Bayer once again. As Anna mentioned earlier, we've got another ruling on the Roundup weed killer, a positive one for Bayer. A court in the US ruling that central claims against the company may not actually be able to proceed to federal courts. They say that the regulations around the Roundup weed killer, which was, of course, supposed to have caused some cancers, potentially should have actually protected the company, and they would not have had to put that on their labels. Now, Bayer saying in a statement that these companies' proof does show that actually this was not a carcinogenic product, and they do stand by the safety of it. But we can see what that's done to that stock over the past couple of years, absolutely slamming it. It's lost about half of its value, even after a couple of positive rulings, potentially around $16 billion worth of claims that are outstanding. But for now, this is a bit of positivity, and we're seeing the stock gaining in the pre-market trading over on Tradegate today. Then in terms of construction, we've got more M&A from Saint-Gobain, the French construction giant. They are doing a deal over in Latin America, spending around $815 million on a company called Obina Group. Now, this is a firm that's expected to bring them around $285 million of extra revenue a year and will be totally financed through cash, which is positive for their debt load. Now, we can see on the screen here that Saint-Gobain is actually a massive outperformer on the French market, up around 160% over the past 5 years, and their international expansion is a big part of that. They recently did a deal in Canada and also Australia as well, and that is part of the reason why investors are really positive on that. So Saint-Gobain potentially one to watch today as well. Then over in chip machinery, a bit of downbeat news coming from Applied Materials in the US. In fact, the profit guidance wasn't too bad. It was pretty much in line with what analysts had expected. But this stock had rallied into the results because people expected there to be a bit more of a boost from AI. And that's a theme we've seen over the past couple of earnings seasons, that the AI benefit is not as strong as expected. And we have actually seen a lot of these stocks pairing their gains in Europe, including ASML, which trimmed its rally year to date and actually declines in BE Semi. Ixtron as well. So Applied Materials not as strong as expected, AI not as good, and as such we might see a bit of weakness in the chip machinery stocks today.
OK, equities reporter Joe Easton on some of the stocks that could be moving this Friday when the session, of course, starts in a little under 6 minutes' time. Joe, thank you very much indeed. Anna, we still, of course, continue to weigh up the data picture out of the US, but also out of the UK with those retail sales pictures coming through. Some discounting, but as you said, the sporting effect of the Euros as well.
Yes, exactly. The weather, the sporting effect. Apparently people going to the pub to watch the football, that was all the rage.
You say that as though you weren't in the pub watching football, Anna.
Of course I was, Tom. But yeah, that seems to... I was just trying to forget about the result that it led to.
Sure, OK, fair enough, yes.
But that was part of the driver, but as you say, some discounting in there. But yes, we're still trading, it seems, off that more positive data in the US as well. Nasdaq futures point higher this morning, up 5%.
It's a little over a week and a half, of course, since that rout in the markets, and we've repaired much of the downside
a long way
in a very short space of time. European futures pointing to gains then of 0.4%. The data out of the US pointing, for some at least, to this Goldilocks scenario. You're looking at a bright picture to start the day on Friday. Stay with us. This is Bloomberg.
Welcome back. This is the opening trade. It is Friday morning. Let's cast our minds back to the Thursday trade on Wall Street and see what clues that might hold for where we go here in Europe this morning. This was the session of yesterday in white here in Europe, and then the blue is the US session on the S&P stateside. And you can see that we tracked it very nicely towards the end of our trading day and into theirs. It doesn't suggest we have a huge amount of ground to make up based on what the US did yesterday, but European futures are pointing that little bit higher. Interesting to see the makeup of the stocks that led us higher yesterday over in the United States. There was tech in there, the likes of Nvidia, given its weighting, has such an impact. But it wasn't just Nvidia, it was a wider tech theme on the rise. And we see that in US futures this morning as well, with Nasdaq futures up by 0.5% or so. We continue to digest the retail sales data. That was something that gave the markets confidence yesterday, and indeed the jobless claims picture as well. All of that reassuring the markets that perhaps the bottom was not falling out very quickly from the US economy. Even if it's slowing, if there are cracks, maybe the Fed doesn't have to panic and cut 50 basis points, maybe 25 is enough, and that seemed to be something that pleased the markets. So we went higher in the US yesterday. We are expecting to go a little higher here in Europe, up by 0.4% on Euro Stoxx 50 futures. The FTSE futures picture is pretty flat though, Tom. What do you see on stocks?
On individual stocks, we are keeping a close eye on Bayer, this long-running legal case over the product that is Roundup, the weed killer, of course, this chemical maker listed here in Europe. Bayer in focus after what seems like another victory in terms of that ongoing and long-running legal case. So we watch that company. There's some deal making around Saint-Gobain as well, the glass maker listed in France, set to acquire Ovniver Group for $815 million US. And we're also watching Applied Materials on the chip read across. Anna.
OK, yeah, absolutely. So the read across from US commentary around the chip sector will certainly keep that in focus. So European equity markets then opening up this morning. The FTSE is pretty flat straight out of the gates. Everything else still closed. We'll be looking for, we might see some catch up on the Italian market. That's not in here, but it was closed yesterday. So we'll be looking for that to play a role because it missed out on the rally of yesterday. So that's something to bear in mind when we're assessing just how risk on we are here in the European session. So some modest gains coming through. The IBEX up by 0.2%, waiting for the CAC and the DAX to open up. There's the CAC 40 up by 0.25%, and we see Stock 600 up by 0.3%. It's a pretty quiet day, though, Tom, when it comes to individual earnings stories, or very quiet on the earnings front. Pretty pretty quiet on the earnings news flow, on the corporate news flow front as well. So it does seem as if we're still in the hands of the macro. And the macro has really been about that US retail sales picture over the last 24 hours.
Yeah, this is a data-driven market for now, it seems. And as you said at the top of the show in the last hour, the good news on the data front seems to be feeding into good news for these markets in terms of risk on equities and the selling pressure coming through for treasuries. Across the UK space, then, you're absolutely right. The FTSE 100 is flat. Part of that is down to the softness in the commodity markets, and that seems to be weighing on the FTSE 100. The CAC going over in France, then, a brighter picture there. Gains of 0.3%. And over in Italy, look at that. Gains of 2%. The upside coming through from the FTSE MIB. On a sector-by-sector basis, Anna, just two sectors very marginally in negative territory, construction and telecoms, but not by very much. At the top of the list, autos getting a lift, up 1.2%. Travel and leisure also in positive territory, alongside banks gaining 0.6%. Every sector in positive territory, apart from telecoms and healthcare, and by only a slim margin. On some of the individual movers, then, we've been keeping an eye on the likes of Saint-Gobain over in France, on a deal-making, but also on Bayer as well. On the top side, coming through, ST Micro, interestingly, in the chip space, gaining 3.5%. You've also got some of those Italian banks performing very well. Banca Monte dei Paschi di Siena, I believe one of the oldest banks in the world, up 3.5%. On the downside, you've got a bit of pressure coming through for the likes of Ferrovial and Hiscox in the insurance space here in the UK, down 1.3%. Anna.
So that's the picture on some of the sector drivers. I mean, Tom, we've been through a few of those stocks on the move this morning. I'm just looking at what's gaining the most points on the Stock 600 right now. I see UniCredit is one of those big gainers, and Intesa Sanpaolo is in there as well. So when you have the Italian market out for a day and then it comes back and it missed a day where banks did OK and there was upside and risk on, well, that's what's going to happen. So we see some of those names moving higher. ASML actually not moving much by in percent terms, up by 0.6%, but adding the most to the Stock 600 right now. And we have an opening price on Bayer.
Bayer performing very well, up 3.8%. Close to 4% is the pop coming through from Bayer, again, on the back of this victory in its long-running legal case. It's not over yet, but it's scored what is seen as a significant victory in terms of that legal case around its Roundup weed killer, which, of course, has faced allegations of being linked to cancer. But there's been a ruling in the US in favour of Bayer, and you're seeing the investor reaction to that now up almost 5% on that German-listed company. Saint-Gobain over in France getting 0.6% on a potential takeover story. And again, in terms of the read across in the semiconductor space, less of an input, really, arguably, given the outlook coming through from Applied Materials. It wasn't terrible for Applied Materials at all, and they do see AI being a driver, but it's a reminder that investors want to see gangbusters forecasts for some of these chip makers. This is an equipment maker, of course.
Yeah, let us move on to another conversation and bring in our guest, Nanette Hechler-Fayd'Herbe, who's CIO for EMEA and Head of Investment Strategy, Sustainability and Research at the Swiss private bank Lombard Odier. Nanette, very nice to have you with us once again. Thank you for joining us this Friday morning. So the broad picture for stocks has looked pretty positive this week. We finished the week with European stocks going higher. US futures look more positive. Talk to us about what you're seeing in the driving seat as we go into a week where we're going to hear from Jackson Hole. There's the potential for new messaging around the Fed.
Yes, I think we are set for some tailwinds for markets. Goldilocks is a good summary. Essentially, the real economy data that were recently out showed a resilient consumer in the United States. And then we are still in this big picture of normalizing inflation, which should put central banks in a very good position to cut rates, the Fed being one of the last to join the group of other central banks that already started. So I think Jackson Hole and the general topic around the effectiveness of monetary policy transmission is going to just nurture those tailwinds. I guess in terms of the next data point that will be important for markets, it's the August labor market report. So that's still a bit way ahead. And as far as the non-economic data are concerned, which are also, at least in the short run, potential drivers, we are certainly still having to keep a good eye on geopolitical developments.
OK, so all of that in focus. Yeah, the labour market report at the beginning of September, that's now going to get a lot of attention. And we seem to be hearing from Fed officials, Nanette, that they're increasingly focused on the labour market as opposed to inflation. And they, unlike many other central banks, have that dual mandate. Is that going to be part of the conversation at Jackson Hole then, as you point out, that the overall topic is reassessing effectiveness and transmission of monetary policy? And there's been a lot of focus on the way that maybe transmission has changed post-COVID, and the labour market could play a role there. What is your focus on the labour market?
Yes, I think for the United States, this dual mandate is really setting the priorities. When inflation is less of a priority, and I'm always looking at the break-even inflation rates as a good gauge of how the Fed is going to shift priorities. When we are close to 2%, it's a good time for the U.S. Fed then to take the other side of its dual mandate, especially when there were signs of weakness, and that is the labor market, the real economy. So I think we are exactly at this inflection point where there is a shift of priorities. If indeed the labor market continues to show this weakness. As far as the transmission is concerned post-COVID, I have to say that there is more noise. It's been much more difficult for central banks to predict inflation because of also policy intervention. Governments and economic policy that is making choices is having an incidence on inflation forecasting. And certainly from our point of view, this is the new thing after COVID.
OK, so on the complexities of monitoring and getting a gauge on inflation. Nanette, good morning. The markets are pricing in one cut from the Federal Reserve every meeting until May of next year. Does that seem reasonable to you?
Yes, I think we are certainly before the end of the year going to see a cut at every meeting. And then as far as next year is concerned, the market will still have to make up its mind in dependency of the U.S. elections results as well. The two possibilities, the two scenarios might very well have incidences on inflation and inflation volatility. Therefore, I'm not so sure about the forecasts that go or the expectations that go beyond into 2025. I think there is still room for adjustment.
Interesting. I wonder how complicated you think the system is, or at least the situation is for the Bank of England here. So the data coming through for the UK showing that there's resilience in terms of the health picture here, in terms of the economy. We heard from Hugh Gimber yesterday, JP Morgan, saying he actually would lean in to UK assets in this environment, both gilts and equities. Would you align with that view?
Certainly on the equity side, we would align with that. We think the equity market in the UK has been one of the laggards internationally. It has a defensive quality as well. I mean, we were talking about now markets all again in a sunny mood, but when there is volatility, the UK market is holding up better than the rest. It has lower volatility, and what is also quite attractive about it is that the dividend yield is higher than other European markets for sure. So altogether, if we take a look then at the sector exposures as well for risk incidences, we talked about geopolitical risks, then this is a market that is looking very attractive to us indeed.
OK, so that's the attractiveness of some UK assets, Nanette. What do you make of the macro backdrop in the UK right now? Because some of the data has been coming in better than, well, actually it was in line with expectations, the growth data yesterday, but quite buoyant versus recent history in the UK. There seem to be some economists a bit nervous about whether we might see an overheating of the UK economy in the second half of the year. And that seems oddly timed with rate cutting from the Bank of England. How would you expect that to square up?
I still take a step back and look at 2024 as a whole. And when I see growth in real terms in the UK hovering around 1.2%, I'm really not in the camp of overheating at all. I think that it is one of these instances where the central banks will and the Bank of England will have further room to cut interest rates if inflation continues on its path. We had confirmation of of that. And in general, yes, when rates are coming down, this is providing support to the economy, but we are starting from a low level here.
Nanette, can European equities gain significantly in the months ahead towards the end of this year? What is the prospect for further upside for European stocks?
You know, European stocks for us have not been among the most preferred regions. We think that there are some headwinds. Yes, certain companies will do very well in certain sectors. We see interesting investment themes, for example, that would be very supportive for selected companies. But for the region overall, we are underweight European stocks. We think that not only is the macro picture weak one, but many of these economies have a very strong industrial base. And as we all know, the industry has been the weak spot internationally, not only in the United States, but also when taking a look towards China and the role it is playing for the global manufacturing sector. So altogether, it's not yet, in our view, the time to have for the region overall a more positive view, I'm afraid.
Nanette, how do you look through the volatility that geopolitics and in particular the Middle East story could provide if we did see a substantial, wider escalation of hostilities there? How are you managing to look through that or factor that into your portfolio in some way?
Yes, for now, one of the decisions that we have taken at Lombard Odier is to keep our allocations really close to strategic levels. In other words, to what the asset mixes are for the various risk profiles that we want to follow, and not take very big deviations versus these strategic allocations, just for the reason that at the moment the market is not pricing very much geopolitical risk. You can take a look at the VIX. It has normalized again. Then you can take a look at US Treasury yield levels. There is nowhere really any form of risk price, and especially also not in oil prices. So we don't want to have too much active exposure at this moment. This may very well change then as market conditions continue. That's a way to look through. And then in terms of just simply assessing risks and making sure that in the allocation we have in some sense the airbags, the strategy airbags that would do very well when there is a spike of risk aversion. We are positive on gold, for example. That is one of the safe haven assets that we like. And we have certainly also some exposure to the energy sector.
OK, Nanette Hechler-Fayd'Herbe, CIO for EMEA at Lombard Odier, on a constructive view around UK equities, the defensive nature there, the valuation call as well, and maybe leaning into a bit of gold. Not so positive on European equities, some caution there. Let's check in on the core six in terms of some of the big name, big cap stocks that we focus in on a daily basis. Ferrari is the standout right now, hitting a record high in terms of the stock price at 418, gaining 3% so far. There's been a surge, it seems, in call options around this stock. So Ferrari's the standout. ASML posting gains of around 0.4%. You saw a forecast coming through from Applied Materials. Applied Materials actually moved lower after that, but top line, Applied Materials results were actually not too bad. ASML up 0.3% as things stand. Novo Nordisk, though, on the downside, down 0.2%. LVMH in the luxury space up 0.4%. But again, it all really comes back to Ferrari as the standout so far. And we'll try and unpick that story for you. But again, reaching a record high right now for 419 euros per share for Ferrari. Let's get a check on some of the other individual stocks on the move. Joe Easton standing by. Joe.
So we've got some volatile trading in Bayer at the moment. It's actually in and out of a trading hole over in Germany. We've got this news, of course, around the Roundup weed killer cases, potentially setting up dismissal of a number of those claims. And the stock up 8.2%. That's actually the biggest gain in 3 years for Bayer today. Really positively taken by investors this morning for that stock. We've also brought up GSK because the company did actually get a favourable ruling in Florida around Zantac, the acid medicine that they've had lawsuits on as well. So this was kind of our court rulings board, but that potentially priced in at the moment. So GSK not actually moving that much at the moment. The other health stock to keep an eye on is Bavarian Nordic, the maker of the Mpox vaccine. Now reports overnight of the first case of the variant in Africa seen in Sweden. However, pretty much the commentary at the moment is that there is not a huge risk of it spreading. But nonetheless, that stock's still gaining. Bavarian Nordic saying that they can provide millions of these vaccines for Mpox over the next couple of years. Obviously, very difficult in terms of the safety on that one, but that is boosting that stock. And there's Saint-Gobain also. We've got that news of that deal over in Latin America, doing another bit of M&A. They've already done a swathe of deals across the world recently. A little bit of a gain, up 0.2% today. In terms of earnings, we're finally getting through the bulk of earnings. We're glad to see the back of them. But here's Kyiv Industries. Now, this one, it's a heating company over in Sweden, also listed in a couple of other Scandi markets. Really strong numbers out of them, up 10%. The best performer we've got. And going the other way is Kingspan in Ireland, seeing a big decline in some of their volumes. It's a construction supplier, Irish construction supplier, down 3% at the moment. Then something a bit more up my street, it's Campari. We've got Aperol Spritz, HSBC analysts. They seem to like an Aperol Spritz over there because they're recommending buying shares of Campari today. That's out of a bit of a sell-off recently, so potentially a bit of value now seen in the drinks maker in Italy, up 3% there. Now, this one caught my eye as well. Now, Citi saying that they recommend selling shares of H&M and buying Inditex, the owner of Zara, because the pricing points at Zara are a bit better in terms of maintaining margins. So we're keeping an eye on H&M. Only a small gain in that one today, but Inditex also worth an eye. Keep an eye on that note. It's on the terminal. Have a read of that one today.
OK, Joe, thank you very much. Joe is only joking. He lives for earnings season. Just can't get enough of it. And maybe the Campari, although I can't speak on that front. Let's move on and tell you what's coming up on the programme. Coming up, Swedish buy now, pay later firm Klarna is pushing into retail banking as the firm prepares for an IPO in the United States. More from Tom's interview with the Klarna CEO next. This is Bloomberg.
People really appreciate mostly about Klarna is that 2 years ago, this business was, very much attractive, growing fast in the US, but also loss-making. And in just 2 years, we have increased revenue by 50%. We have increased gross profit by 100%, and we reduced cost in 30%, which means that now we are, profitable. And I think those kind of financial performance obviously do raise the eyebrows a little bit with investors. Also, as we have, due to AI, committed to continue shrinking the company. We've already gone from 4,500 to 3,500 in the last year, and we are committed to continuing on that path, not by layoffs, but simply by natural attrition rates.
You've been an early mover on Gen AI, and you reached out to Sam Altman of ChatGPT, OpenAI, pretty early on in all of this. What's been one of the most surprising things that stood out to you as you've embedded some of this Gen AI across the business?
Yeah, I think that it is, to me, in a way, I would actually partially say that, like, I was even, kind of pulled into the hype a year ago, where a little bit like, again, self-driving cars, we used to read about them in the press every day. And then you would look out the window and like, where are they? Where are they? It's not happening. And now it's actually happening. And I think that, like, to some degree, I was almost like drawn into the hype a year ago as well. I was like, okay, in a year, the whole thing will already have like totally dramatically changed everything. And now you almost have the opposite. You hear people like, oh, we tried it, didn't give us the results and so forth. But internally, what I'm seeing in Klarna is that it is working. It's just, it will take a little bit further time before it will have the full implications. To us, we've already had delivered some fantastic results, but we're super excited what's coming in the next 12 months.
Before we let you go, Sebastian, look, what do we win you back? You're going to list in the US. That's the suggestion. That's the expectation. What does Europe and the UK need to do? Is there anything they could do to win this listing?
Well, one thing that I have said to regulators in the EU, because there's been so much discussion in Brussels as well, how do we create a competitive market? And I have suggested, and I actually got some positive from some of the foreign ministers. I was invited by all the finance ministers of EU, is that I think that if Europe will never agree on, like, where should the big stock market be? Is it Paris? Is it Frankfurt? Is it whatever European country? So the only way to actually get this to work is if you would mandate all the stock exchanges in Europe so that any stock that gets listed in one is automatically traded in another. I think that could reach the critical mass to create an investor base that is, similar size to the one we see in the US, because that's really one of the biggest challenges when you make those comparisons. If a company like ours is already mostly US business, from revenue size, it will have to be a similar size of investment base and stock market size to make it a relevant listing point.
OK, Klarna's CEO and co-founder speaking to me a little earlier on Daybreak Europe, also saying he's seeing, Anna, strength in terms of the demand out of the US in terms of the consumer there. They have partnerships with a number of big retailers, including Walmart, which also posted its own earnings and outlook as well. But they're seeing strength in terms of the US consumer still buying. OK, so that takes us on to our next conversation then, nicely, Tom. Walmart shares jumped after the company boosted sales guidance for the full year and reported adjusted earnings that beat estimates. The US retail giant also raised its targets for operating income and profit. Joining us now to discuss, Bloomberg's consumer goods reporter Dasha Afansieva. Dasha, good morning. So what stood out to you in this earnings report from Walmart?
So they said that most of the growth came from upper income buyers, which I thought was interesting because, as we know, companies like Nestle and Pepsi have complained particularly about the state of the US consumer on the lower end. So Walmart's response to this has been drawing in the higher income consumers. The other thing that bucked the trend was China, thanks to their Sam's Club membership format. They actually grew sales double digits over there. So that also bucks this trend of the slowing consumer in China. And finally, their health and wellness business grew well due to GLP-1 drugs. And they said that they're actually not seeing any weakness in that bit at all. So it's a very different tone to what we've been seeing from retailers and consumer goods companies over in the States.
Yeah, to that point, Dasha, we've heard complaints from the likes of Pepsi, executives at Nestle cautioning about the state of the US consumer. We know about the Starbucks story as well and the pullback there on splashing out on, $6 cappuccinos. But it's a different picture for Walmart. What are they getting right? What are they doing differently?
A very different picture. I mean, to actually be able to grow operating profit more than sales at such a time is quite a feat, especially when they're saying that they are lowering prices on lots of products because they are having to cater to a very stretched consumer after many quarters of high inflation, high interest rates. And similarly, they're also recognizing a higher income consumer that they're also say they're catering to by focusing on convenience and product assortment. Another thing that it seems like they're doing well is their private label. It continues to grow. And of course, that's kind of an opportunity for supermarkets as people trade down. And e-commerce, another huge source of growth, is growing more than 20%, and that's a massive pillar of their strategy. Something that I also spotted, which I think Walmart might make Walmart ahead of others, is what they said on AI. So a lot of consumer companies are talking about how this is a game changer and how they're doing lots of stuff, but they're not really quantifying what it is that they're doing. And in this release, Walmart said that they found 850 million pieces of data that's either been created or improved through AI. And that's helping them predict what consumers are going to want and reduce inventories and reduce costs.
Dasha, thank you very much. Yeah, really interesting, those positive comments on AI. We just heard from Klarna, sort of talking about how it maybe doesn't always deliver. Dasha, thank you. Dasha Afansieva joining us there from the Bloomberg News team. Coming up, UK retail sales bounced back in July as rising real wages and lower inflation lifted confidence. We will discuss all of that. That's coming up next. Still working through some of that inflation data of years past. A more normal situation now. This is Bloomberg.
This is the opening trade. We are 30 minutes into today's session, and it is risk on. Broadly across these markets, you're seeing gains of between 0.2% and 0.3%. The data out of the US certainly supportive in terms of the drop down in jobless claims and the increase in retail sales, and of course inflation early in the week coming in slightly cooler than estimated, all seeming to align for a soft landing scenario. At least that is the take from many. The data also crossing, of course, out of the UK. We had retail sales here bouncing back in the month of July, thanks to sunnier weather. Yes, we did have some, and that helped to spend increased spending in department stores, and, of course, rising real wages here in the UK has lifted confidence as well, at least in the margins for the UK consumer. You have the sporting effect as well with the Euros and, of course, the Olympics. Let's bring in Karen Johnson right now, Head of Retail at Barclays. So it seems like the consumer here is showing at least some signs of resilience, but when you lift the hood, there's some intriguing developments in terms of changing spending habits, Karen. Talk to us about what you're seeing in terms of the retail space. What stands out to you right now in terms of the health or not of this UK consumer?
Yeah, morning, Tom. We've seen some really interesting trends coming through, but the first of all is that there's no denying the fact that the unseasonable weather has had a real significant impact on consumer spending behaviour. We've seen a lot of deferral of spending until the weather improves. Our research indicated that 2 out of 5 consumers said they would defer their spending until the sun started to shine, and that is exactly what you've seen. And it's great to see that the sunnier weather means people are returning to the high streets and spending. Underneath that, there are 3 key trends that we're seeing. The first one is the cost-conscious consumer, really being thoughtful about their spending. The second one is we're seeing people spending and choosing to spend on experiences over material possessions. And thirdly is the fact that 45% of consumers are still looking at ways to reduce their discretionary spending to ensure that they can support their household bills. Coming through that's had an impact on some purchases like clothing, which are down. Again, you don't go out and buy your shorts and your flip-flops if it's wet outside, but hopefully we'll see that coming through. I'm starting to see that emerging, and also as people are going on their holidays. And the rising star of in terms of retail spending is health and beauty, which has continued to rise month on month as people invest in their health and well-being.
OK, interesting. So health and beauty and the experiences versus necessarily going out and buying hard goods and maybe clothing items, at least for now. Karen, to what extent is this being funded? To what extent are the consumers here in the UK having to dip further into savings or indeed the credit card to kind of fund this spend right now?
Well, that's the interesting point, Tom, is that we aren't seeing those savings levels reducing, and credit card volumes in terms of the people paying off their credit card is actually on an improving trend, indicating that people are managing and living within their means. At the moment, we've seen that as a real positive trend. Obviously, is also impacted by interest rates. People sort of less, more reluctant to borrow, but equally, those people especially in the older demographic, who are continuing to save and are making good returns on their investments.
Karen, in another dynamic, in another part of the retail space, you talk in your notes ahead of our conversation about digital content and the amount of money people are willing to pay for that. To the extent that you talk about streamflation, this is an area of the economy where, and we know the Bank of England focuses on services more broadly, but this in particular is an area where we haven't seen those inflation rates maybe normalise.
Yeah, I mean, there's quite a bit going on underneath the surface of that. If you look back a couple of years when there was probably only really Netflix came on, they came on with some really strong opening, costs. Was it $10.99 a month or something like that? Since then, we've seen significant competition coming into the market. And now most households are having perhaps 2 to 4 different streaming services so they can access all the different material that's out there. And that's leading to an increase in the costs of streaming, per household. And obviously the cost of actually producing the content is also giving rise to an increase in the cost of those services. Most households have seen a significant increase in that. And with the sporting events coming through again, there's a renewed focus again in terms of ensuring that they have access to watch the Premier League football or whatever their preference is in that household.
Yes, and what can you tell us from your data and your research about the economic confidence that people in Britain have right now. It was interesting at the last Bank of England's press conference, listening to expectations in the wider population about inflation, and they're not entirely back to normal levels. They haven't come back down. But what about prospects for the economy as a whole? What are you seeing?
That's actually one of the most positive aspects that came out of our most recent consumer confidence survey. Back in April, 25% of people had confidence in the UK economy improving. By July, that's increased 32%. That's the highest since 2021, which is a real positive. And if we can see that trend increasing month on month, as people having more confidence in that, that interest rates are coming, will start to come down, that inflation is under control, they will start to see that hopefully coming through in terms of confidence in their discretionary spending that's available once they've paid their household bills. And that will then hopefully lead to a rise in consumer spending, which will benefit the UK economy.
OK, Karen, so that's interesting. So in terms of the lower rate environment, so we've had one cut so far from the Bank of England. Expectations are that they won't go again in September, but maybe they go in November. How closely aligned is that mood, that sentiment? How sensitive is the UK consumer to a move lower in rates?
Unfortunately, I think with the events that have been going on more broadly in the last couple of weeks, the media sort of coverage of the fact that mortgage rates have started to come down has probably not been as high as many people would have liked to see. But I think as that rate expectation is going to come down for a further cut, and we start to see mortgage rates start to reduce, this will not have an immediate impact on funding spending availability, but the confidence that when they come to renew their mortgages, those that have still got fixed rate mortgages due to expire will know that actually the quantum that's going to be is less than it would have been 3 months ago, and that's got to come through. But it will take time to really be felt by the man on the street in terms of what's available at the end of the month. It will also take time to come through in terms of those people who are in the rental situation, because obviously the landlords who've got commercial mortgages have refinanced. The costs will take time to come through to benefit them as well. But hopefully the fact that they are on a downward trend will give people the confidence that they're not going to go up, so they don't have to put further funds aside to look for that rainy day that may come. Hopefully won't now.
Karen, is there any part of your data set that gives us any clues as to whether we might see some overheating possibly in the UK economy in the second half of the year? Bloomberg Economics has been writing about this possibility after the data on growth that came out yesterday. Of course, we've got the Bank of England looks set to cut interest rates, which wouldn't be what you'd do if you thought you were going to see overheating. But is there anything in your data set that suggests in any sense that people are spending a bit too much?
No, quite simply, we haven't seen that coming through at all. I really wish I could say we're seeing that coming through, but at the moment spending is at best flat, and we really want to see that coming through. It's lower than the inflation rate in terms of the growth in spending. So until the growth in spending comes through at a higher level than inflation, that's perhaps the only time to start thinking about that.
OK, Karen, thank you very much. Thanks for joining us. Karen Johnson, Head of Retail at Barclays. And Tom, it certainly has been a busy week when it comes to the UK data picture. We started off the week with some data that actually moved the pound, and not all of the data this week has done that, but it actually sent the pound a little stronger at the start of the week, and that was around the jobs market. Some of this data is a little bit broken, though, isn't it? Or at least not to be relied upon as much as you would like. The unemployment number, it's difficult to get people to answer the surveys. Do you think
it's fair to say it's a slightly harder call to get a clear steer on the UK economy versus the US? Because of the mix that's coming through. When you look at the employment surveys, for example, and the wage growth that remains above 5% but has cooled, but the unemployment rate coming a little lower, CPI, so inflation above the target for the BOE, so above that 2% target, coming in at 2.2%, but below the estimates. It starts with a 2 handle.
Yeah,
we were double digits.
Given where we've been, it's just kind of incredible to think that we're now quibbling over.
And the fact that you, Anna Edwards, are talking about an overheating UK economy.
Well, I'm just channeling Bloomberg Economics.
It's your big summer spend.
It's as if Dan Hansen is here in the room with us. He puts in the effort, and I just ask the easy question.
I mean, when you put it in the context of the fact this is the strongest growth we've seen, this is the kind of growth level levels you see on a quarterly basis in the UK since pre-pandemic. This is the kind of level you see. That context is there. Look, this is a Labour government that wants to get, what, plus 2% growth? We're not there yet. Yeah. But this is a stronger picture than many had assumed would be at the start of this year.
And still a lot of questions about how you're going to get to that growth. It can't all be house building, and there is going to be some confidence effect, it would seem, or at least that's what they seem to be relying on. We had an economist on earlier this week who was saying that that can deliver something, and we'll see how much of what we saw in the last month is sustainable, given that we saw that warmer weather and the football and all of those other temporary factors that pushed up spending.
But you're notching up 0.7% growth or 0.76% growth on a quarterly basis in an environment of interest rates at 5.25%. They've come down to 5%, but that's been the level, and you're still managing to grind out that growth. And that's a very different picture to the likes of Germany and arguably France as well.
Yeah, and we're going to get more clues on the Eurozone picture for growth next week. We get those PMIs coming through. And interesting, our guest at the top of the hour talking about how we really should focus more on the services story. And that seems to stand out as an area of still growth for France and Germany. I was just looking at those particular countries. But the manufacturing story there is well below the 50 mark, suggesting contraction. And that's an ongoing drag on the Eurozone economy.
Yeah, and if you are worried about inflation still being there, still embedded in the system, then it's services which draws your attention, doesn't it, and the relative strength in terms of that particular carve-out. Coming up, Sweden records, we're going to switch focus now, Sweden recording the first case of the new Mpox variant outside of Africa. Also reports that cases have been found in Pakistan as well. That's a day after the World Health Organization declared a global health emergency. We're going to bring you the latest on these developments. That's next. This is Bloomberg. Welcome back to the opening trade. We are 45 minutes into today's session. The gains have been paired a bit, but you're still seeing some upside across the European benchmark. Stock 600 currently up 0.2%. To Sweden now, which has reported a case of the new Mpox variant. It's the first recorded outside of Africa. Bloomberg healthcare reporter Janice Q joins us for some of the details on what is still a pretty fast evolving story. What more do we know about this particular case then in Sweden?
So the person presented themselves in Stockholm for medical treatment, and they identified it, as you say, as this variant. The Swedish authority says that additional infection control measures are not needed at this point, but they do take this particular clade very seriously, or this particular variant very seriously, and they will be keeping a close eye on the situation.
And what more do we know about what's happening here then, Janice? Tell us a bit more about the wider containment efforts that we're seeing.
So the area itself is a very tricky area to work in. It's difficult to get good surveillance, although there are a lot of efforts being made. And, you know, with the World Health Organization and the Africa CDC declaring public health emergencies, a lot of action is happening. And it is being taken very seriously. We are seeing other countries talking about upping their surveillance. So we got news from China that they are going to be looking very carefully at any inbound from Africa, any inbound travel. In Nigeria, they have intensified their monitoring and screening. In the Ivory Coast, they actually reported their first case 10 days or so ago, and last month. And they actually invited, I'm just going to read it because it's quite dramatic sounding. They've invited anyone keeping live wild animals without proper authorization to hand them over to the nearest forest station, or risk facing up to 20 years imprisonment and about $166,000 fine, which wow. I think is quite a strong measure.
Yeah, indeed. And that's one example of some of the measures that the authorities are taking then to try and curb the spread of this virus. Talk to us about what we can think about, how much reassurance we can take from vaccine makers. Where are we in terms of producing the vaccines, getting them out to people who need it at pace?
Yes, the vaccine maker, the main vaccine maker, Bavarian Nordic, has said that they've got stock, and they have actually been building up stock for some time. You might remember that in 2022 we had an Mpox outbreak globally. This was a different strain. It was a less virulent strain. It is still circulating, that strain, and so Bavarian Nordic has already built up some stockpile. Getting it onto the ground is more complicated for a few reasons. There are logistics around it that are tricky in the specific area that is the sort of epicenter, I guess. There are other issues. So the US has said that they are willing to donate. They had quite a stockpile from 22 that is still effective. It hasn't expired or anything, but they do need the countries to request it. And so the Africa CDC and the WHO, with other partners like Gavi, the Vaccine Alliance, UNICEF and the likes, are really trying to move things along as quickly as possible.
Thanks very much, Janice. Thanks for joining us. Bloomberg healthcare reporter Janice Q, keeping us up to date with the latest developments on Mpox. Let's switch our focus now to climate matters. Italy and the Balkans are on red alert, and Greece is bracing for more wildfires, with temperatures forecast to climb as high as 42 degrees next week. With climates on so many people's minds and on investors' minds, the situation in the region is set to see the issuance of more catastrophe bonds, and we could see the level of issuance there power past the record set last year. Joining us now on a number of these stories, Bloomberg's Eamon Farhat with details. Eamon, good morning to you. So is this summer, is this going to be out of the ordinary this summer in terms of the heat and the fires?
Yeah, I mean, it has been very hot. There's been lots of wildfires this summer, and scientists and meteorologists do talk about it being, an anomaly every time that these extreme heats do hit. When we think about last summer, the summer before, it seems like this anomaly is becoming the norm, and meteorologists are saying that we're having more and more extreme heat, more and more, hot summers in Europe where we're reaching 45 degrees Celsius in some places. So it does seem like this extreme heat is becoming more of the norm.
And when we talk about extreme heat in the summer in Europe, we inevitably include Greece in the list. But how widespread is this kind of geographically in terms of the extreme heat we're seeing in Europe? Or is it focused on a couple of countries that really are focusing on feeling the brunt of these increased temperatures?
Yeah, I mean, Greece, the Balkans, they've definitely been, at the forefront of this extreme heat. But parts of Spain, as I said, reached, I think, 47 degrees, a couple of weeks ago. Even the UK, we got our hottest day on Monday, reaching 35, which doesn't seem that hot. But in the UK, where there's not as much air conditioning, where overnight temperatures, if they don't drop below 20 or so, that can be quite difficult for older people. Extreme heat is hitting all parts of Europe. Some parts definitely more than others. But, from Paris, London to Athens to Madrid, extreme heat is everywhere this summer.
And how bad are the fires then, Eamon, when you compare them to other years?
Yeah, so I mean, the fires in the last definitely couple of years have been quite bad. This year, I think I was checking the data this morning, about an area the size of Greater London has already burnt this summer all across Europe. There was obviously that fire outside of Athens, which burnt, a huge area. The issue is that, these countries do pool resources. They do kind of share planes and firefighters, but if they're all being affected by wildfires, that makes things very difficult. So, you'll have jets being sent from France to Greece, but if France also has extreme risks, then it becomes very difficult to spread these resources across all the nations affected by wildfires.
OK, so that's some of the burden sharing that we see between nations, and you give France and Greece as an example. When it comes to the financial costs, what are the potential implications of just how much this is going to weigh on national budgets?
Yeah, I mean, right now, Europe is spending, billions and billions on fire prevention. I mean, right now, they do spend about 90% of their budget on actually fighting fires, not preventing them from starting in the first place. And there is more of a shift towards these longer-term solutions to try and prevent, the fires starting, whether that be public awareness, whether that be kind of different kinds of buildings. But right now, it seems that when the fires do hit, they're literally putting out fires, so they don't have time to be thinking about these longer-term plans. Something like 40 billion euros right now is being allocated towards these kind of measures, and that only seems to grow. They're trying to buy more planes, have more equipment, have more training, because every year it's becoming more and more serious. And if they don't act, they know that the consequences can be really catastrophic.
OK, Eamon Farhat with the details and an update there in terms of the importance of the extreme heat and what it means, of course, on a social level, but also financially, economically for the nations hit as well. Eamon, thank you for the update. Here's what else to watch out for today then. 1:30 p.m. UK time, we're going to get some details around US building permits, so that will give us a gauge in terms of parts, at least, of the housing market. We get the housing starts as well. That will be a sector, of course, screaming out, you would have thought, for those rate cuts, with mortgage levels coming back down in the States. So mortgage rates have moved lower stateside, but we'll get a gauge in terms of the housing market as well. And at 3 p.m. UK time, in terms of the consumer sentiment, we're going to get another touch on that with the University of Michigan Consumer Sentiment Survey. So that drops at 3 p.m. UK time. After that, positive outlook coming through from Walmart, even as they did talk about some downshifting in terms of consumer purchases. And at 6:25 p.m. UK time, we're going to get some more Fed speak, this time from Austin Goolsbee. We've already heard from him. He can speak at an event as well. So we'll see if he's adjusted his view, given the data that's come through in the last 24 hours out of the States. And finally, Moody's is going to be giving a sovereign rating on the nation of Ireland.
And we are going to have to wait the whole of next week. So Jackson Hole does start the middle of next week. But we have to wait the whole of next week to hear from Jerome Powell. The Fed chair is going to be speaking, but not until Friday at Jackson Hole. We'll, of course, bring you that live here on Bloomberg TV, 3 p.m. UK time. So that'll be quite late into the week, won't it? By the time it happens.
Given that speech happens on Friday, to what extent will markets and investors be wanting to put on big bets before they hear from Jay Powell? And you pointed out you want to hear from him as to whether he aligns with what we've heard from the likes of Raphael Bostic and Austin Goolsbee.
Yes, because they're pivoting more towards the labour market data. Is Jerome Powell doing that as well, and a little less emphasis on inflation? Interesting that we heard from Nanette Hechler-Fayd'Herbe earlier on in this hour. She was saying that she thinks the message from Jackson Hole will be one that will nurture the tailwinds for risk assets, so one that will reassure, whether that's something like, it won't be as obvious as, yes, we're going to cut rates in September, but, you know, there might be something that leads the market in that direction.
Will that reassurance involve pushing back on expectations from some still in these markets that you get 50 basis points in September? Because would that smack of panic?
Yes, I think maybe that is certainly what the market's going to be looking for. And since yesterday's data print, we see even more commentary around how 50 maybe not needed, 25 is what the market should be looking for.
In terms of the movers today, as we talk about markets and focusing on some of the individual stocks, Ferrari is a standout. And as Anna was talking about, certainly in the break at least, and I'll bring you Anna's insights right now, the fact that Italy was closed for a national holiday yesterday probably accounts for a lot of the upside that you're seeing in Ferrari. But the gains there, and we saw a record hit in terms of the pricing, and we are still above that record level for the stock at €419 per share. So that car maker, luxury car maker, doing very well in the session, up 3.2%. Stellantis, different segment, of course, of the auto market, also doing quite well. And the auto sector, one of the best performing sectors. So Stellantis up at 2.8%.
Yeah, I mean, the auto sector was sold off, wasn't it, with a lot of that negativity in markets and the volatility that we are trying to all forget about. But it wasn't all that long ago. Ferrari had a good day on Wednesday, even before markets were closed. On to Bayer, and Bayer shares are on the rise after winning that appeal in the Roundup litigation, though, as you pointed out, Tom, it might not be the end of the story, but it is up strongly this morning. Bavarian Nordic, then, Tom?
Look, we got an important update from our healthcare reporter in terms of the spread of Mpox, with all the caveats that we're not seeing the kind of virulence that we had seen with something like COVID. But nonetheless, this is a company that provides the vaccines, so it is going to get a boost on the back of that, Bavarian Nordic, with the vaccines around Mpox. OK, quick check on some of the big listed mining and commodity names more broadly. A little bit of sluggishness partly explains the underperformance of London today. Stocks broadly in Europe are up. London is down a little. That's it for the opening trade. The Pulse is next. This is Bloomberg.